Yeah, last speaker of the day, Peter, the floor is yours.
Thank you. I think I have to applaud you for still being here, meaning that your staff are really interested into insurance. Yeah, one of it is it. So welcome to the talk, taking on slashing risk from insurance point of view. My name is Peter Bärnreuther. I'm the Chief Underwriting Officer of Chainproof. Let me show Chainproof in one slide. We are a fully regulated insurance company, so picture us as a traditional insurance company taking on Web3 risk. We are licensed in Bermuda. We have wonderful partners like Sompo, which is Japanese second largest insurance company, Munich Re, largest reinsurer in the world, and Quonstem, leader, one of the leader in smart contract or general Web3 security. But enough about that. We are insuring against smart contract and slashing risks. So we are often talking to node operators about slashing risk, and we saw that we have very different perceptions. How node operators see the risk and how insurance companies see the risk. And I'm not talking here about Chainproof, but I'm talking about the whole insurance industry. So did slashing event happen? Yeah, 300 slashing events happened on the mainland in the last 3 years. That's not too many. If we say we have like 800 active validator, let's be fair, perhaps in the last 3 years on average it's more like 200 validators. The right annual insurance rate should be more like, you can argue, like 330 ETH which got slashed, divided by 3 because 3 years, and then divided through the staked ETH, which is 32 ETH times 200 validators. And you come up with a very, very low rate. So even if you're then a mid-sized validator, you shouldn't pay more than 1,000 or 2,000 US dollar per year. Now you can imagine that if you call an insurance company, I want to insure against a slashing loss of 100 million, but I'm paying perhaps, or I think the fair price is 2,000 US dollar, the contract probably will not happen. So why is this, or how do insurance companies think about this risk? So basically, how to price a risk, there are 2 ways. First way, you have a lot of data, then you just use the data of the last, perhaps let's say 50 years, and adjust it a little bit, like with car data, traffic data, you know the value of the cars going up, the driver behavior goes a little bit up, but basically you have data of 50 years, so you can really do your pricing. But what is about new risk? Yeah, 3 years is not a long time, so how do we price the 3 risk? And one common method you are using is basically you split it up in 3 different parts. In basis losses, these are the very small losses, like one node gets slashed, might it be from a large node operator or solo staker. But that's totally irrelevant from a cost perspective, perhaps not from a reputation perspective, both for the insurance industry and for the node operator. Then we have large losses. This in the insurance industry would be mean that perhaps the whole node operator gets slashed. So we are talking here about 6, 7 figures. So it's really relevant for the node operator. This might be a huge operational failure, and as well relevant for the insurance company. So for both. And then we have these catastrophic losses, where basically the whole Ethereum network goes down or is threatened to go down. But where from an insurance perspective, not only one node operator has losses, but several of your policies at the same time default. And so your losses adds up. These is basically the mental model which we are using. So basis losses, we have seen quite a few, but large losses and catastrophic losses never happened. Or did they? I think they did, so let's go in there. I brought 8 cases with me where I think large losses or catastrophic losses almost happened, and let's go through them. So the first one is a software bug in the Prism client. So perhaps all of them you can find on chainproof.co, it's co.com, at our blog. The latest blog post, I describe exactly these 8 accident, and as well with you find the original post-mortem. So there was a wrong response of 1 of 6 different time servers. So this led to an event where the Prism client was not thought it was a different time than he saw the stamps on the beacon chain. So basically no attestation was more going on. The Prism team rushed them to push a fix to the problem. Unfortunately, this fix contained then a critical bug, and 3,000 validators were slashed. Luckily, on the mainnet, on the testnet, so nothing really happened, but you know, something like this, totally unexpected, might come up one time in the mainnet as well. Second example, I think, is a classic. Node operator tries to get a better performance. He's testing a testnet. Mainnet behaves differently, so the nodes some validator nodes start to restart. The slashing prevention database is disabled, never a good idea, and so there were a lot of slashing events, around 75 or 95, there are always different number around of these nodes were slashed, so 100 ETH were lost, would be now about 200,000 K, and at this time the validator count was quite low. So I would argue this is already let's say medium event. Then example 3, again a software bug in a validator client. They were unable to produce blocks in a period of 18 epochs, and again 18 epochs. This led to a decrease in validator participation. A leak mode was not triggered, but it was very close at this event. Example 4, a node operator had a lot of validator clients, several beacon nodes, but all validator clients were basically connected to one beacon node due to an operational failure. And because all of these were hitting a single beacon node, it became much less responsive, and some blocks were becoming orphaned. So this is perhaps not a slashing event, but where you can see, okay, an operational failure is ongoing. Example 5, it was on a testnet. Here a fuzzer created an invalid block, and this was deemed valid by 2 of the execution client, and so the network split up. Yeah, if we would have this on mainnet, the main chain splitting into 3 different ones, this would be catastrophic. Example 6, this was basically the primary net was on, and the node operator deleted some of the validator clients, but it wasn't really deleted, the keys were re-imported, so suddenly you had backup validators going online, and this caused a slashing event from 11 ETH. Then example 7, some consensus client could not process valid attestation with an alt target checkpoint in an optimal way. So the network was flooded with alt attestation, and I think 3 out of the 4 main clients recomputed prior beacon states, which was a lot of computational power, and the network went down. So we were in leak mode because and basically the network was saved by 1 validator client, but the network was in leak mode. Since we have the quadratic formula, the impact was very small, but nevertheless. And then another event only like 1 month ago, 20 nodes were slashed because the fallback data center was brought on, and here the Web3 signer didn't had a slashing protection enabled. So these were 8 cases. So let's review our basic assumption again. We have the basis losses. Here I would say we have already, like 150 events have happened. We would have already some data, but unfortunately nobody wants to insure against this because it's just irrelevant from a monetary perspective. So let's delete these. And the big question is now about large losses and catastrophic losses. Yeah? Large losses we have seen can happen. This would be an operational failure, like the backup system goes on and again. We haven't seen it yet, but in principle, an external hack can bring down the infrastructure or steals the validating key and then enforces a slashing. Same could happen and grumpy internal employee who still has access, or some software bugs. So 4 of them happened in the past. The severity was low, luckily, but this might be that it's not this case in the next 100 years. And similar, and I would argue we had some more I haven't seen for everyone a post-mortem. And what is with this catastrophic losses? If you are making a little brainstorming, there might be a validator bug, execution line bug. We have seen both of it. Okay, a failure of the underlying Ethereum network after an upgrade might come. DVT and overloading consensus, I still have to make my mind up, so not sure about it. And leak mode, I think, is very realistic scenario as well. So the question really boils down, and this is where the different perceptions coming in. Insurance is not against these basis losses. Yeah, we have seen these on the network, but nobody buys insurance for this one. This would really correspond to these low rates from 0.002%. The real question is, what do we give the probability for a large loss or for a catastrophic loss? And the answer is we don't know. Yeah, we have to make some assumptions, but basically here it's important. Do you think it's 1 time every 100 years, 2 times every 100 years, and then you can come up with a basically fair rate. So in the end, what can we do from the insurance industry? Or what are our challenges? Well, it's very technical. It has quite a technical complexity, even for a cyber underwriter. And the data quality is quite okay, but the quantity is not there yet. And a challenge for us is as well the accumulation risk. So leak mode, downtime, software bugs, failure of the underlying Ethereum network. This would be risk where perhaps many policies separate are affected, and this would perhaps lead to a large loss, which we as an insurance company have to avoid. And how to overcome these challenges, mitigate slashing risk and get insurance costs down. What can we do? Well, the data will improve over time, so we get this in our favor. We can do technical improvements. DVT might be a solution. I think we still have to wait for the results from the test nets, doing a little bit more research here. What are insurance specifics? We can try to exclude these cat risks to make it insurable for us. And what we are always using in the is this alignment of interest through self-insured retention and loss participating, so that we both have an interest that no slashing occurs. Then last point, what can node operators do? We're doing an awesome job at the infrastructure setup, of course. Education of the insurance market is always a topic as well, because it's quite difficult what you guys are doing. Following best practices which we doing currently together with Lido in the DAC initiative. And then ISO 27000K and SOC 2 certifications are also, I think, something what a lot of node operator is doing currently, just to give these positive signaling effects. And last not least, Quantum is doing specialized slashing-specific infrastructure audits, which are basically complementary to the ISO and SOC 2 certifications. That's from my side. Thank you for that you have been here. If you have any question, you will find me outside, or feel free to shoot me an email. If there are any, thank you, and if there are any questions.
Questions? Maybe I have one. Can you insure against lost keys?
This would be custody risk. There are many, we are in Chainproof not doing it, but there are many companies who are doing it. This is more a risk which traditional insurer feel more comfortable. So like Coinbase also, they bear a lot of these risks. Hot wallet risk or cold wallet risk, both of them. Yeah.
Hi, thanks for your talk. I'm just wondering, is this a market for institutions only in terms of risk mitigations and risk policies, or is it also, like, is it for solo policies, let's say for solo staking? Is there demand, or do you offer products for this?
I don't know if there's demand, but it's difficult because the insurance companies always do some risk assessment, and with solo stakers it's just tough. Yeah, so usually it always depends what is the technical knowledge of the insurance company. If it's low, then they rely on certifications like 70,000K audits, ISO 70,000K certifications, and then basically it's getting tough for solo stakers. Yeah, so solo stakers with few nodes, then the premium would be as well too low for the insurance industry or to the insurance company to start the process. So, no.
Thank you, great talk. My question is what drives the demand of the insurances? Like, what kind of people are coming, and do you see during the last years that the demand of slashing insurances are increasing?
We see basically node operators who talk to institutions. They are asked by the institutions, by the compliance team of the institution, do you have insurance? And that's a checkpoint. And if you say no and 3 others node operators say yes, you are out of the game. So basically it's, yeah, it's a marketing tool, a signaling tool, and a risk transfer tool. And what we as well see, node operators are buying it when they think they get more business out of it, so that it basically pays for itself.
Okay, thank you again.